Welcome to Ask a Property Manager, episode number 112. Today we're going to be talking about major changes to how credit scores are calculated, and your score might actually wind up going up as a result. Stay tuned. It's no secret that landlords and property managers rely on credit and background checks when we start making decisions on applicants for apartments. We rely on the information that we get from our credit bureaus in order to make a risk assessment on that applicant before we make the determination whether or not we want them to be our tenant. But what happens when the bureaus make changes to the way that they look at the data? That's exactly the situation we find ourselves in currently with all three of the major bureaus. Equifax, Experian, and TransUnion are all making changes to how they score credit files, specifically when it comes to medical debt. We're taking a look at an article today published locally by WGRZ and written by Chris McCrory out of Washington. We're going to go ahead and jump right in here. Your credit score could soon be going up. Here's why. The move will improve the credit scores of millions of Americans saddled with low-cost medical debt. Go ahead and scroll down here. The three largest credit bureaus in the United States announced Friday that they would begin removing most medical debt from their reporting process starting in July, meaning many Americans with late or unpaid medical bills could have the strains from those bills wiped off their credit. The three companies, Equifax, Experian, and TransUnion, are responsible for figuring out the credit score used by banks, loan offices, and other financial institutions to determine how likely a person is to pay back a loan or debt. The significant changes announced Friday will remove nearly 70% of medical collection debt from the Consumer Reports, TransUnion said in a statement. The company cited months of industry research and information about the kind of debt incurred by most Americans in reaching the decision to change the long-standing practice of how debt is calculated. According to the Kaiser Family Foundation, about two-thirds of medical debt comes from medical expenses that arise from an urgent need and are usually one-time or short-term charges. The credit reporting agencies said that the COVID-19 pandemic was part of the reason that they felt the change was necessary due to the number of medical bills racked up by patients with COVID. Some credit score models, which are used to determine somebody's credit score for what is known as a soft pull check, have already stopped looking at medical debt. VantageScore and FICO, both popular services for credit checks, began disregarding paid medical debt several years ago and de-emphasized unpaid medical debt compared to other bills. However, a hard pull used when taking out a large loan, such as when applying for a pre-approval to purchase a house, tends to use scores generated by the major credit agencies. As of July 1st, any debt will be wiped from the credit report of consumers. Any paid debt will be wiped from credit reports of consumers, meaning that late payments won't damage their credit. The credit reporting agencies will also increase the time period before unpaid medical debt will appear on a person's credit from 6 months to a year. The extra delay is designed to give people more time to pay back their bills. And sometime in the first half of 2023, none of the major credit agencies will include medical debt under $500. Medical collections debt often arises from unforeseen medical circumstances. These changes are another step we're taking together to help people across the United States focus on their financial and personal well-being, said a joint statement provided by Mark Berger, CEO of Equifax, Brian Casson, CEO Experian, and Chris Cartwright, CEO TransUnion. As an industry, we remain committed to helping drive fair and affordable access to credit for all consumers. The move is huge for millions of Americans because a credit score is one of the most significant factors lenders use to determine their ability to get a mortgage, car loan, and start a business. It can also impact the ability of someone to get a job or rent an apartment. The Consumer Financial Protection Bureau, a financial watchdog, has previously criticized the nation's billing system for medical expenses, saying that it often failed consumers through errors in billing that are common on credit reports. The agency found an estimated $88 billion in medical expenses weighing down the credit scores of Americans. These errors can be difficult and costly for consumers to fix, and even paying any late bills doesn't help in some cases. Marks against someone's credit can last for nearly a decade, even if an error put them on there. Without the marks from the credit agencies, some people could have their credit score jump by hundreds of points. Few people chose to take on medical debt, yet millions of Americans have experienced credit report coercion, where they're pressured to pay medical bills that they may not even owe to prevent a black mark on their credit report that can threaten their employment, housing, and credit prospects, a spokesman from CFPB said in a statement. This is particularly egregious since CFPB's prior research has demonstrated that medical billing data reported on credit reports is typically an unreliable indicator of people's ability to pay their bills. The CFPB says that about 20% of U.S. households will have some kind of medical debt in 2022. The move by the credit agencies is expected to effectively wipe away tens of billions of dollars in derogatory marks against the credit scores of U.S. consumers. The removal of debts under $500 is particularly important for Americans because most unpaid medical debt is below that mark, according to CFPB. So there you have it. There is the article. I do want to comment a little bit on it here, just based on the impact that I think it's going to have for us as we move forward. So what exactly is this going to mean for us as we go to screen tenants? Well, obviously it means that the scoring that we're seeing is going to be a little bit higher than what it may have been prior to this change taking place. As far as excluding medical debt from the credit record goes, I can see both sides of the argument here. This is not going to be a popular opinion, and I can guarantee that. But what I look at here is what we just went through in the state of New York with the eviction moratoriums and restrictions on what landlords and property managers could and could not do when it came to managing their property and collecting rents and things of that nature. Essentially, New York landlords were put in a position where they were told to either accept emergency rental funds offered by the state, and if you refused to accept those funds, it gave the tenant an argument at court that you refused funds that were made available to you. Then after 12 months, the landlord is deemed to have waived, I want to make sure I have this right. After 12 months, the landlord is deemed to have waived the amount of rent that would have been covered by the ERAP payment. That's a direct quote from the ERAP website, by the way, which is why I wanted to make sure I got it correct. I look at that as a direct interference in a two-party contract by a third party. Landlord and tenant have a contract, and now a third party, in this case, the government, is coming in to disrupt that contract. What is this 12-month thing? Like, that really kind of bothers me. Why does the government get to decide what debt is more valuable than other debt? Why does the government get to decide that we're no longer allowed to collect on funds that are legitimately owed to us? If a tenant lived in the unit during that time frame, the funds are legitimately owed. Why does the government get to say, no, you don't get to collect on those funds simply because you're refusing to negotiate with a third party, essentially? Now, taking a 30,000-foot view here and applying the same logic to medical debt, why does a credit bureau, a government, or anyone else get to decide what debt has more value or less value? Why do they get to decide what industry debt matters and what industry debt does not? And this is not anything new. It's not like the debt disappears here, by the way. The person still owes that debt. We just have no idea when we're trying to make a risk assessment that that debt is out there and that it has an impact on that person's financial situation. The way FICO scores are computed has been a secret sauce since the beginning of FICO. It's not something that's publicly accessible as to how things are truly calculated. There's some good ideas out there as to what percentages of things are, how things are looked at on a percentage basis versus different types of debt that you can use to get kind of an idea, but different debt gets looked at differently. Credit card debt and mortgage debt and medical debt are not considered equal when it comes to determining someone's credit score. So these credit bureaus, which are private institutions, they're not operated by the government. Technically, they can do whatever they want that way. But when you're making a risk assessment based on the information that's provided to you by a third party, and that third party is changing the way that they provide that data to you, you have to consider that when analyzing your risk. Now, all of that said, I'm not a horrible gremlin. I'm not really upset that medical debt's getting pulled off credit bureaus. I think that pretty much everyone has a very good understanding of how jacked up the medical system, the healthcare system here is in the United States, and how easy it is to fall into medical debt. All it takes is a minor illness or a broken bone when you don't have medical insurance, and you could find yourself in a world of hurt. The number of times I've seen medical collection accounts under $500 is absolutely crazy. And they specifically mention in that article, anything under $500, even if it's an open account, is not going to pop up on your credit profile. The number of times I've seen those small medical collections is crazy. Little medical debt holding people back from being able to advance in life is a bad situation. Obviously, the best case scenario here is that everybody pays their debt and everybody gets to move forward, but we know that that's not always going to be the case. That's a bigger discussion than I'm willing to have on this forum. That's a discussion that's way outside of the scope of what we're talking about here today. Anyway, thank you for watching. If you learned something today, do us a favor, hit that like button, hit that subscribe button. And if you have a friend or family member that needs to learn this too, do us a favor and share it with them. And let us know your thoughts. Do you think that this is a good idea? Do you think that it's a good thing to pull medical debt off of a credit report? Or do you think that it should remain there so that accurate risk assessment can be done? We'll talk to you soon.